Well, we have a mutual fund and we have an ETF, but which one is better? I'll save you some time. Mutual funds stink. Whew. Of course, there's more to the story than that, so stay tuned and let's get ready to give ourselves a raise. So let's start off by addressing why I say mutual funds absolutely stink, and I also want to address the title of this video. It says, why would you do this? I am specifically referring to the fact of why would you go into a mutual fund when there's other options. I'm going to break it down and really compare the big key differences between the mutual funds and the ETFs. By the way, ETF equals exchange traded fund. So if you're ready to learn some cool things, don't be dumb, tap the thumb. No, not that one. All right, let's start off with mutual funds. Now, a mutual fund is an actively managed fund where a manager of a fund makes moves within buying and holding stocks and securities with the goal to try and beat the market. Now, the S&P 500 over the long period of time has averaged about 10% growth per year. The mutual fund manager's job is to try to beat that because you're entrusting them with your money when you buy a mutual fund, and their goal is, I got to make you some money. But there lies the problem. A very big problem, in fact, because if you actually compare and look at the statistics, typically, even though the S&P has averaged 10% growth, a mutual fund is somewhere in the range of 6 to 8% growth, meaning that they never beat the market. So we're going to break down side by side the difference between a mutual fund and an ETF. In fact, I'm going to go right here to the middle, and over here, we're going to talk about mutual funds, and over here, we'll talk about ETFs. Now, one primary similarity between the two is that they offer the ability to buy into many different stocks instead of putting all of your eggs into one basket. You know, the old adage of, if I buy a single stock, that's like one basket. If I put all of my eggs into that one basket, and let's say that individual stock falls, goes out of business, or something terrible happens, well, you know what happens to your eggs. So the cool thing about either one of these is it gives you a little bit of a spread opportunity to diversify and not be all trapped up with riding and dying with one particular company. Of course, let's talk money first. Let's talk about the fees between either one of these things. Now, here's the big difference. A mutual fund, which is actively managed by either managers or one manager within a company, they charge a pretty darn high fee of 1% typically. 1%. That means that you're paying 1% just to have this dude over here manage it. Compare it over here to an ETF. An ETF such as, for example, SCHD has an expense ratio of 0.06%. No, that is not 6%. Literally 0.06%. So over here, with the example of one particular ETF, we have a 0.06. Over here, we got a 1%. Now, you're never going to see this fee. It's not like they send you a bill at the end of the year and you got to put in money into an envelope and send it back to them. They actually take this out of your value, out of your portfolio that you have with them. So typically, it's like an invisible fee, but don't worry, the fee exists. And I think personally, 1% is a lot of money, especially if it's not beating the market. So point number one is, why pay these guys when you can do it yourself and buy an ETF? Next up, let's talk about investment between the both of these. Now, they both offer, of course, that basket of stocks, as I mentioned earlier. But the key point is mutual funds are only traded once per day. Now, if you have an account already, let's say you have a retirement account that holds mutual funds, go in and check it someday, and you'll notice that it doesn't update the balance typically until the end of the day or until the next day. That is simply because the value only gets changed once per day as a result of that one-time trading window. Now, an ETF can be traded like a stock in the stock market. So when the market is open, you can trade, buy, sell an ETF if you wanted to, all in one single day, thanks to the fact that it's treated just like stocks on the stock market. There are some cases where a mutual fund will also require you to have a minimum deposit, especially if you buy into that mutual fund for the very first time. Sometimes we can see $3,000, $1,000, $5,000 just to buy into that mutual fund. And if you don't have that much money right up front to get kickstarted, you kind of are stuck. You either got to save up the money or forego the mutual fund purchase. An ETF, you can buy based on the share price. So a good example is you could actually go into Robinhood, link down below, get yourself a free stock with Robinhood when you sign up, and you can buy a fraction of the ETF. That's what's really cool about that particular brokerage app. You go in, you buy half of a share, or if you have enough money, you can buy the whole share, but it's all based on the price of the ETF. There's no minimum deposit requirement for an exchange traded fund. So if you haven't already guessed it, there's a big reason why I said that mutual funds stink, and also why I don't recommend getting that. So why would you do this? Why would you go and get a mutual fund when you can do the same type of thing with an ETF that follows very similar sectors, markets, and things that you might be interested in investing in for the long term? So let me just push the point just a hair further. And this is where it's really, really interesting. I want to break it down from a financial perspective. Okay, so I'm going to pop up my iPad screen. I'm going to write here along with you. Let's talk about SCHD again. Remember, that is the ETF that I was talking about a little bit earlier that comes with a 0.06% expense ratio at the time of this recording. Now, if you think about that, that means for every $1,000 that you invest into SCHD, you pay a total of 60 cents. Okay? Now, compare that to something like a mutual fund. It doesn't matter which one, but let's say it is that typical 1% fee, okay? Which means for every $1,000 that you invest in that fund, you are gonna have to spend $10, my friend. $10 for that. So if you got $1,000 and you're debating between, do I get an ETF like SCHD or do I just get some random mutual fund? Look at the fee differential here, guys. We're talking about 60 cents versus $10 for the course of the year. I think the answer is kind of obvious, isn't it? But let me take this another step further. Let me erase all this garbage. And what I want to talk about is the fact that one thing that we fail to realize sometimes is, let's say you're in here and all of a sudden you're working with a financial advisor, okay? I'm going to say Fin Advisor, okay? So we got a financial advisor. They actually charge you 1% as well for managing your portfolio for you. That can be a fine thing, especially if you're starting out or you're not sure what to do. But where it gets interesting is, let's say they start investing in mutual funds for you. You take your money and they're putting it toward mutual funds, which also charge you 1%. Now you're actually paying a total of 2%. 2% for your money to be put to work. Okay, so if you find an ETF, a good quality ETF, and I'm about to share with you a great place to find good quality ETFs in just a moment, but you're gonna save yourself so much money in just the overall fees. Let's say, for example, they actually meet the market. Like I mentioned earlier, mutual funds don't typically always follow the market. Sometimes they lag behind. So let's say the market right now is 10%, and this particular mutual fund did return 10% as well over the last year. Well, if you had a ETF that had 10%, you would get a return of 9.94% because of that 0.06 fee. Now, of course, some ETFs have different expense ratios. Always look that up before you buy. But in this case, in this example, 0.06%, that means your return with the expense taken out is 9.94%. But if you're using a financial advisor that puts it into a mutual fund, look at what happens here. For this example here, you are only going to get, that's right, an 8% return. 8%. So if we compared apples to apples, we both put in $1,000 and we're watching it grow. I'm sitting here at the end of the year with a 9.94% return and your butt only gets 8%, but it's the same type of thing. Let's say they invest in the same type of sector. They get the same type of return. I'm making more money per dollar versus a mutual fund. Now, I want to pull up this screen and check this out. This is the website I was talking about earlier, etfdb.com. This is a great way to find yourself some good quality ETFs based on what you believe in and what you want to do with your particular portfolio. So if you look down here, you can do an ETF screener, which means you plug in certain values to get a list of what they recommend. You get ETFs by type. So for example, if they're a government, bond, sector, anything like that, ETFs by geography, and ETFs by issuer. So let's say, for example, we want to do a screener. I'm going to click on screener just to give you an example of what I'm going to type in here. So right here's our screener. So let's say we're worried about expenses. I'm going to click on expenses, and it's going to bring up from the back here the expense ratio. So look at this, and then I can filter it up by just clicking on this from high to low. Of course, I'm never going to go with this one right here, which is a 10% expense ratio. That's absurd. That is in line with the mutual fund. Instead, I'm going to click it again, and now it's bringing up those that have a very low expense ratio. Look at this. Here are some that you may have heard of. BTI, VOO. There's SCHB. I'm sure SCHD is somewhere in here as well because that carries a 0.06. We're not quite there yet. So let's go to page 2. Here we got a 0.04. Here's some more Vanguard funds. And you can see just all of these great things. Now, there's a lot more to it than just looking at expense ratios. Of course, you want to look at your assets. You want to look at what kind of class it has. You want to look at the actual financials of the particular ETF before you make any type of buy-in decision. But I just wanted to share with you an example of where you can really look through and find some good quality ETFs. This website is absolutely free to use. I'm going to go back to the main screen, in fact, and let's say, for example, you want to do a little bit more of a deep dive. You want to go into ETFs by type. You click on that, and then you can look at what you're most interested in. So check out what we got here. We got bonds, commodities, consumer discretionary, staples, energy, aerospace. Let's say you're somebody that's interested in aerospace, for example. We can click on that and it's going to pull up ETFs that are based on aerospace. So that could be really cool if that's something that you're passionate about, that you want to dig into more, that you think is a good, worthwhile investment. I always recommend do stuff that you understand. Don't go invest in something that makes no sense to you because you'll never know really what's going on with that particular industry. Beautiful thing about an ETF is it helps you really get yourself set up for that large basket of different stocks so that you don't break your eggs. So really, if it comes down between mutual funds and ETFs, well, I think the case is pretty obvious. With lower fees and the ability to trade throughout the day and invest in what you're most passionate about, I think the ETFs obviously win. And the best part is, if you really wanted to, in certain retirement accounts, you can also invest in ETFs. It's a great way to get started by building your portfolio. If you don't have a lot of money to start with, check out Robinhood, get that app, get your free stock, and then you can start transferring a small bit of money in, maybe every week or every month, to start your ETF building journey. If you enjoyed this video, tap the like. Here are 2 other awesome videos that might help you with your personal finance journey. And until next time, we'll see you on the next video.